All right, let's take a hard look at ACHR Aviation, ticker ACHR. The U.S. markets are closed for the weekend, and looking at the data from Friday, November 7th, 2025, it was a brutal session. The stock closed at $8.175 per share, marking a sharp drop of 7.94% on the day. It was a volatile ride, with the stock opening lower, dipping to a session low of $7.20 before recovering some of that ground. This wasn't just a minor pullback. This was a significant reaction to the company's third quarter 2025 earnings report that hit the wire after the bell on Thursday. Now, the immediate surface-level narrative, what most people trading on the Robinhood app or doing some light self-investing saw was the headline, wider than expected loss, and the subsequent 10% pre-market plunge. The expectation was that this was another pre-revenue tech company bleeding cash, and the EPS number was all that mattered. But the reality, the actual story that institutional desks and serious analysts are looking at, is so much more complex and, frankly, more interesting. The real story isn't the $130 million net loss. The real story is that in the same announcement, ACHR reported a massive $650 million new capital raise and $126 million strategic acquisition of the Hawthorne Airport in Los Angeles. This wasn't just an earnings report. It was a fundamental shift in the company's entire posture, and the market is struggling to price in this new complex reality. The common belief for ACHR has always been that it's a binary bet. It's a high-risk venture that you either believe in or you don't. The expectation is that you buy it in your SoFi Invest account or maybe use Robinhood fractional shares to take a small position, and then you just wait. You wait for one single piece of news, FAA certification. The belief is that the moment they get that final type certification, the stock will surge, and everyone who held will look like a genius. It's treated as a spec play, a lottery ticket on the future of urban air mobility, similar to how early Tesla stock was viewed before it ever turned a profit. But that expectation is dangerously simplistic, and this earnings report just proved why. The reality is that this isn't a one-and-done certification story. This is a game of logistics, manufacturing, infrastructure, and capital endurance. Thinking this is just about the FAA is how retail investors get burned. The real challenge, the one ACHR just confronted head-on, is not just getting certified, but having the capital and the physical infrastructure in place to actually operate a commercial service the moment they are. The $130 million loss or the $126 million in cash used in operations is the bear case. But the $650 million capital injection, bringing their total liquidity to over $2 billion, is the deafening bull response. ACHR just effectively signaled to the market that it's willing to outspend and outbuild its competition. Let's break down that recent stock movement because it tells a fascinating story. That 7.9% drop to $8.175 wasn't a straight line down. The fact that it opened low, plunged to $7.20, and then rallied back over $1 to close above $8 shows a clear battle. The initial plunge was the algorithmic and panic selling from those who saw the loss. The recovery was almost certainly institutional buyers, the ones using a Fidelity trading platform or interactive brokers, reading the full report and realizing the significance of the $2 billion war chest and the airport acquisition. This is the kind of investment action you have to look for. When you look at the institutional filings, you see a similar story. In recent quarters, major players like Vanguard, BlackRock, and D.E. Shaw have been adding millions of shares. While some executives have been selling shares, which is never great to see, the big money institutions are placing massive, long-term bets. They are not trading the daily swings on the Fidelity mobile app. They are buying a multi-year thesis. This brings me to the core dilemma for anyone looking at this stock. Analyst ratings are overwhelmingly positive, with a buy or strong buy consensus. Needham just reiterated a buy on Friday even with the price drop, though they did trim their target to $10. Other analysts, like H.C. Wainwright, have targets as high as $18. The median target is sitting around $12.70, and yet the stock is at $8.17. Comment below with what you think is the real reason for this gap. Is it the FAA delay risk, or is it a massive buying opportunity? For those just tuning into this name, or perhaps doing their first bit of online investing research, let's clarify what Archer Aviation does. This isn't an airline. Archer is designing and building electric vertical takeoff and landing, or eVTOL aircraft. Think of them as electric air taxis. Their flagship aircraft, Midnight, is designed to carry a pilot and 4 passengers on short, 20 to 50-mile trips, hopping over the traffic that clogs major cities. Their business model is to both manufacture these aircraft and operate their own urban air mobility network. And now, with the acquisition of Hawthorne Airport, they have a physical, strategic hub in Los Angeles, a key market, especially with the 2028 Olympic Games on the horizon. This isn't just a plan on a slide deck, it's a real estate-backed operational plan. This brings us to the future outlook, where we must once again frame this through expectation versus reality. The expectation has been that Archer, with its high-profile backing from United Airlines and Stellantis, will be one of the first to market. The risk, and the new bear narrative, is the timeline. Reports in October suggested that full commercial operations might be delayed until 2026. This is the biggest weight on the stock. It doesn't matter how great the tech is if the regulators aren't ready. However, the reality from the company's side is continued progress. The Q3 report highlighted new flight milestones, a 55-mile flight, 31 minutes in the air, and reaching an altitude of 10,000 feet. This is the engineering validation. They're also targeting the first FAA type inspection authorization testing by the end of this year, so the company is hitting its technical goals. The central tension is this: the market is punishing the stock for a potential timeline slip, while the company is simultaneously de-risking its financial and operational future. That $2 billion in liquidity is a fortress. It gives them a massive runway, one that competitors like Joby might envy. This is no longer a question of if they have the capital to survive. The question is purely one of execution and regulatory timing. This kind of high-stakes situation is precisely why many financial advisors recommend diversified Fidelity mutual funds or a hands-off Schwab Intelligent Portfolios account. The volatility is too much for most. An individual brokerage account with a huge position in ACHR is not for the faint of heart. It's a world away from the relative stability of Apple stock or the proven growth of NVIDIA stock. This is a pure play on a future industry, and it requires a strong stomach and a long-term view. So, to summarize, the narrative on Archer Aviation is far more complex than Friday's 7.9% drop would suggest. The expectation was that the Q3 earnings would be a simple referendum on their cash burn. The reality, it was a strategic masterstroke, a declaration that they are moving from a research and development company to a fully funded infrastructure and operations company. The market's fear, seen in that stock price, is focused on the timeline. But the institutional buying and bullish analyst ratings show that the smart money is focused on the end game. This isn't a simple stock for a SoFi robo-advisor to manage. It's a complex, forward-looking investment that demands deep research from anyone using investing sites or a Fidelity brokerage account. The story is no longer about survival, it's about the timing of the arrival.